Stop. Take a deep breath. Close your eyes for a moment. And think about the last time you felt true financial FOMO, that gnawing electric sensation that everyone else is getting rich except for you. Perhaps it was 2021, watching your friend brag about quadrupling their money on a single volatile meme stock. Perhaps it was seeing a digital influencer flash a screenshot of their massive gains from option gambling. Maybe it was a pervasive cultural noise screaming about the impossible, dizzying returns of the latest crypto hype cycle. Everywhere you look, the financial world feels like a relentless, confusing game of chance, rigged by sophisticated algorithms and controlled by a handful of untouchable geniuses. You are told that to succeed, you need insider information, a PhD in quantitative finance, or the willingness to sit at your desk for 18 hours a day trading. You're told that the age of simple, quiet, patient investing is dead, that the only way to achieve your dream of financial independence, retire early fire, is through aggressive, speculative moves that carry the risk of spectacular, immediate ruin. Now, imagine that one of those untouchable geniuses, a man who has actually managed one of the most successful hedge funds in history, a man who has genuinely beaten the market for decades, decided to tell you the truth, not a complex, opaque mathematical truth designed to confuse you, but a truth so simple, elegant, and timeless that you could teach it to a fifth grader. This is The Power of the Little Book That Beats the Market by Joel Greenblatt. It is a quiet revolution disguised as a children's story. It is a lifeline thrown into the turbulent waters of modern financial madness, proving that the most sophisticated investment strategy is often nothing more than common sense, discipline, and a little bit of arithmetic. The author and his unexpected gift. To appreciate the simplicity of Greenblatt's message, you must understand his pedigree. Joel Greenblatt is not a theorist. He is a practitioner. He is the founder of Gotham Capital, a hedge fund he managed with astonishing success from 1985 to 2006, averaging annualized returns that crushed the broader market indexes. He taught finance at Columbia University's Business School, the very home of Benjamin Graham, the intellectual father of value investing and the mentor to Warren Buffett. Greenblatt operates within a tradition that prizes logic, conservatism, and meticulous valuation over speculation and hype. In a financial world obsessed with complexity, Greenblatt decided to perform the ultimate act of intellectual generosity. He distilled decades of hard-won, market-beating wisdom into a short, accessible book. The Little Book That Beats the Market, first published in 2005, was revolutionary not because it offered a new, arcane strategy, but because it took the most powerful concepts of value investing, concepts that often require complex financial statement analysis, and stripped them down to their bare, understandable essentials. The book's core is not a secret tip or a fleeting trend. It is a universal law of finance. Greenblatt reframed investing not as a science reserved for the elite, but as an opportunity available to anyone with patience and the ability to find good businesses at cheap prices. He didn't just teach the secret. He offered a working, back-tested, repeatable method, the famous magic formula. The brilliance of Greenblatt's writing is that he uses the voice of a wise, empathetic mentor, explaining concepts like return on capital and earnings yield through simple, human analogies, often framing them as lessons for his two sons. This narrative style is what makes the book, and this script, so vital for today's Robin Hood generation of investors who crave clarity and disdain unnecessary financial jargon. The book's urgent relevance in the age of hype. Why should the modern investor, armed with zero-commission trading and infinite access to data, turn to a book written over 2 decades ago? Because the psychological forces that Greenblatt's formula exploits, greed, impatience, and short-term thinking, are the very forces that have been exponentially amplified by the digital age. The Little Book That Beats the Market is a necessary anchor in a financial world unmoored by hype, connecting value to the digital casino, FOMO, and crypto. The central tension of our time is the struggle between the measured, long-term approach of value investing and the instant, seductive gratification of hyper-speculative behavior. Lewis's book, The Big Short, showed us the dangers of collective denial in the physical world of housing debt. Greenblatt's book offers the blueprint for avoiding the digital equivalent, the crypto hype cycles, and the meme stock manipulation that plague the market today. The magic formula is designed to identify companies that are fundamentally undervalued. It forces the investor to ask, What is this business actually worth? This is a question the FOMO culture never asks. When a stock or a coin surges 500% in a month because of a tweet or a Reddit post, the price has become completely detached from the underlying business reality. Greenblatt teaches that if you buy a good business for a cheap price, its value will inevitably be recognized by the market over time. This principle is a direct rejection of the greater fool theory that fuels modern bubbles, where you buy a speculative asset only because you believe a greater fool will buy it from you later at a higher price. The Bitcoin bubbles and NFT madness are fueled by narrative. Greenblatt arms you with a tool based on the cold, hard fundamentals of profitability and cost. The FIRE movement and the need for discipline. The FIRE movement emphasizes disciplined savings and passive index investing as the safest path to financial independence. While effective, it leaves many investors wrestling with low-grade anxiety. Is there a way to prudently accelerate the process? Greenblatt offers a compelling answer that bridges the gap between passive acceptance and reckless speculation. His formula is not about day trading. It is about active, intelligent stock picking that can deliver market-beating returns, the kind of boost that can shave years off the retirement timeline. Crucially, the book requires emotional discipline and patience. The formula works over 3 to 5 years, not 3 to 5 weeks. Greenblatt's lesson is a profound challenge to the Robinhood generation that views market volatility as entertainment. The formula generates returns because it forces you to buy what is currently out of favor. Companies trading at cheap prices because the market is temporarily overlooking them. When you buy cheap and unfashionable stocks, you will, by definition, endure periods of underperformance. This need to stay calm when the short-term news is bad is the necessary, non-mathematical ingredient for the formula's success, making the book a vital study in long-term thinking. The counterpoint to financial influencers. In the 2020s, the financial influencers and gurus have created an economy of shortcuts and complexity, often pushing high-fee funds or highly speculative stocks. Greenblatt's little book serves as the ultimate, free, transparent counterpoint. The formula democratizes the expertise of the hedge fund manager. It proves that you don't need a tip from a financial TikTok guru. You need a simple, repeatable process that finds value. By focusing on 2 universally available numbers, earnings yield, how cheap the stock is, and return on capital, how good the business is, Greenblatt empowers the average person to ignore the noise and conduct a sophisticated form of value analysis right from their home computer. It is a powerful message of financial self-reliance, teaching the investor to trust a proven, timeless process over the fleeting, volatile predictions of the crowd. It is the ultimate toolkit for anyone seeking to be a true active investor without succumbing to the complex, costly mistakes of traditional active management. A cinematic journey into simplicity. Over the course of this breakdown, we will take each of Greenblatt's 15 chapters and expand their core concepts into deep educational segments, ensuring every step of the formula is explored and connected to the real-world financial pressures of today. We will look into the mathematics of the formula, but more importantly, we will examine the psychology required to stick with it when the rest of the world is betting on hype. This is a story about finding profound within the simple. It is about understanding that the biggest secret to beating the market is not some complex, futuristic algorithm, but a simple, disciplined, and slightly old-fashioned commitment to buying value. Prepare to unlearn what the headlines have taught you and embrace the simplicity that leads to lasting financial success. Chapter Breakdown. The little book that beats the market. Chapter 1. The investment superpower you didn't know you had. In fantasy worlds, superpowers look like lightning bolts and invisibility cloaks. In finance, Joel Greenblatt opens his book by revealing a very different kind of superpower, one that is quiet, invisible, and far more profitable. The freedom of being an individual investor. Greenblatt's surprising insight is simple but devastating. In the battle between professionals and amateurs, the amateur has the unfair advantage. Institutional investors, those with billion-dollar mandates, are trapped in a system that forces them to behave irrationally. Their constraints become your opportunity. This chapter isn't about formulas. It's about psychology. It explains why the professionals you admire are actually fighting a daily war against their own limitations, and why understanding those limitations unlocks your power as a free, independent investor. The institutional prison. Why professionals must fail. To see your hidden advantage, you must first understand the shackles weighing down the hedge fund manager. Greenblatt identifies two iron constraints: relative performance and short-term time horizon. Constraint 1, the curse of relative performance. A professional investor is not paid to make money. They're paid to beat a benchmark. If the S&P 500 rises 20% and their fund rises 25%, they are a genius. If the S&P 500 falls 20% and their fund falls only 15%, they are still a genius, even while losing client money. This creates a career-killing dilemma. A deeply undervalued stock, one that screams long-term opportunity, might underperform for a year before turning around. If a manager buys it and it lags the benchmark for just a few quarters, they risk losing their job. The result? They avoid unloved bargains and instead cling to the same expensive stocks everyone else owns. Herd safety becomes survival. Keynes captured it perfectly. It is better for reputation to fail conventionally than to succeed unconventionally. Professionals can't afford to be outsiders. Individual investors must be outsiders to win. Constraint 2, the tyranny of the short term. This is the real killer. Professionals are evaluated quarter by quarter. 2 or 3 weak quarters can trigger investor panic, withdrawals, and career-ending consequences. Their survival depends on delivering quick, visible results, not long-term value. But Greenblatt's strategy requires 3 to 5 years for the market to recognize a company's true worth. Professionals simply don't have that time. Their clients won't tolerate it. So they chase momentum. They chase hype. They buy what is already loved, not what is truly valuable. The individual investor, meanwhile, faces no quarterly firing squad. If you can hold an investment for years instead of months, you unlock a strategy that professionals are structurally incapable of using. This is your superpower. And Greenblatt's message is clear: use it, activating the superpower, time and smallness. The individual investor, unburdened by these institutional handcuffs, possesses two immense structural advantages. Advantage 1, the gift of time and patience. Your single greatest weapon is your unlimited time horizon. If you are a fire-based asset allocation investor or someone practicing dollar-cost averaging DCA, your goal is to build wealth over 20 or 30 years. A year of underperformance, or even 2, is a statistical blip, not a career-ending crisis. You have the luxury of buying a great company at a cheap price and simply holding it for 5 years, confident that its intrinsic value will eventually be recognized. This patience allows you to pursue the essence of Greenblatt's strategy, buying stocks that are currently unloved, forgotten, or temporarily misunderstood by the market. You get to be the smart buyer at the garage sale that the impatient, quarterly-driven professional is forced to ignore. This is a foundational prerequisite for the magic formula to work. Advantage 2, the privilege of smallness. The second superpower is the ability to move swiftly and quietly in the market's forgotten corners. Greenblatt explains that massive institutional funds managing billions of dollars are limited to buying only the largest companies' large-cap stocks, because buying shares in a small company would give them too large a percentage of ownership, making the position hard to buy and even harder to sell. If a $5 billion hedge fund wanted to buy a deeply undervalued $100 million small-cap stock, they might instantly own 20% of the entire company, forcing the price up and revealing their hand. They cannot access the market's deepest inefficiencies. You, the individual investor, can buy and sell $10,000 worth of shares in that tiny, ignored, fundamentally sound company without moving the price 1 cent. You have the privilege of hunting in the least efficient, most fertile grounds of the stock market, the small and mid-cap spaces, while the giant are forced to fight over the same handful of overanalyzed, overpriced mega-cap stocks. Your superpower is a combination of time and smallness, giving you the perfect conditions to exploit the short-term, herd-driven mistakes of the very professionals who are supposed to be smarter than you. Modern investing reflection, wielding the superpower in the digital age. Greenblatt's lesson is even more critical in the 2020s, an era shaped by zero-commission trading, social media-driven panic cycles, and the overwhelming dominance of ETFs. These forces offer individual investors unprecedented power, but also unprecedented temptation to abandon their greatest advantage: patience. The zero-commission trap. Zero commission trading liberated retail investors, removing friction and opening every market with a swipe. But this freedom comes with psychological price. When trading feels free, overtrading becomes irresistible. Investors abandon multi-year value theses in favor of quick momentum trades, the very behavior that destroys long-term returns. Greenblatt's strategy depends on holding undervalued businesses long enough for the market to recognize their worth. An investor who trades daily or weekly forfeits the time horizon superpower and voluntarily steps into the same short-term cage that imprisons institutional managers. Passive investing and the value vacuum. The explosion of ETFs and index funds funnels billions into stocks with zero regard for valuation. Capital flows blindly into entire baskets, good, bad, expensive, and cheap alike. This creates fertile ground for disciplined stock pickers. Companies too small, too dull, or too unfashionable for the index become deeply undervalued opportunities. Passive investing minimizes failure. Greenblatt's active value approach maximizes returns if the investor maintains discipline. The hype cycle and emotional discipline. Tesla manias, Bitcoin surges, and meme stock frenzies test an investor's psychological resilience. Social media manufactures urgency, urging constant action. Yet, true power lies in resisting the noise. Professionals cannot buy boring, cheap stocks without risking their careers. You can. Your superpower is a freedom to be patient, rational, and small, holding great businesses for years while the world chases illusions. Harness that discipline, and you fully activate the advantage Greenblatt reveals. Here is Chapter 2, The Secret, where Joel Greenblatt lays the intellectual groundwork for his famous formula. Chapter 2, The Secret. If Chapter 1 equipped you with the individual investor's superpower, time and freedom, then Chapter 2 reveals the intellectual blueprint. In a short but transformative section, Joel Greenblatt cuts through a century of financial noise and condenses the entire craft of successful investing into two unforgettable principles. This is the secret, and its brilliance lies in the fact that it is both obvious and relentlessly ignored. The secret is this: by stocking good companies at cheap prices. It sounds embarrassingly simple. Why, after all the quantitative models, PhD-level theories, and algorithmic dominance of Wall Street, would the key to superior returns be something your grandfather could have told you? Because, as Greenblatt demonstrates, nearly every investor, professional or retail, breaks one or both rules every day. Professionals, terrified of falling behind benchmarks, buy good companies at expensive prices simply because everyone else is doing it. Retail investors, fueled by FOMO and speculative culture, chase bad companies at cheap prices, hoping for a miracle. True, consistent outperformance only emerges when you combine the two pillars. Pillar 1, identifying the good business. A good business is not defined by hype or popularity. It is defined by return on capital, ROC. ROC reveals how efficiently a company turns investment into profit. A pizza shop that earns $30,000 on a $100,000 investment is a far better business than a giant factory earning $5,000 on the same capital. High ROC businesses have durable competitive advantages, a moat that allows them to reinvest profits and compound wealth year after year. Pillar 2, identifying the cheap price. Finding good businesses is easy. Finding them at cheap prices is the art. Greenblatt measures cheapness through earnings yield EY, the inverse of the PE ratio, which tells you how much earnings you receive for every dollar you invest. A higher EY means a richer income stream at a lower price. Why mispricing exists? The magic formula works because markets are emotional and structurally short-sighted. Investors routinely 1. Overpay for certainty, bidding great companies up to unrealistic valuations. 2. Panic over temporary problems, selling excellent companies at distressed prices. The secret is a disciplined exploitation of these predictable swings, buying great businesses when the market temporarily forgets their worth. Modern investing reflection, value versus hyperspeculation, and the digital moat. Greenblatt's core philosophy is the essential counter-narrative to the financial pressures of the 2020s. It stands as a powerful rejection of the quick, easy wealth promised by option gambling and leverage addiction, the antidote to option gambling and leverage. The speculative fervor of option gambling and leverage addiction thrives on volatility and price momentum, fundamentally ignoring the underlying business quality. A trader placing a bet on a short-term, out-of-the-money option is making a price prediction, not a business investment. They do not care if the company has a strong return on capital, the good business. They only care if the price moves fast enough in the right direction to make the contract profitable. This disconnect from business fundamentals is what makes option trading closer to a casino bet than an investment. Greenblatt's secret forces the investor to slow down and consider the intrinsic value. If you're focused on buying a business that is high quality and generating excellent earnings, pillar 1, you gain an immediate margin of safety. If the stock drops, you still own a great business that will continue to generate cash flow, giving you the calmness and patience needed to ride out volatility. This intellectual discipline is the ultimate defense against the self-destructive spiral of hyper-speculative behavior. The modern moat, identifying good in the tech era. Greenblatt's concepts of good business, high return on capital, are timeless, but the sources of that quality have evolved in the digital economy. The modern moat is often built on data, network effects, or digital platforms. For example, a software company may require minimal tangible capital, no factories, inventory, or physical assets, but generate massive amounts of profit from its subscription model. This company would show an astonishingly high return on capital, even though its assets are intangible. The disciplined investor must adapt Greenblatt's concept of ROC to this reality, looking beyond physical assets and recognizing that the efficiency of a business, its ability to turn $1 of sales into a high percentage of profit, remains the key determinant of quality. The most valuable modern companies are those that generate massive profits with low marginal cost, confirming Greenblatt's focus on capital efficiency. The passive versus active bridge. The secret provides a perfect bridge in the passive versus active investing debate. Greenblatt is an active investor because his method requires you to select individual stocks based on fundamental metrics. However, his method is inherently passive in its execution. You use a formula to find the good businesses at cheap prices, but then you must hold them for 3 to 5 years, ignoring the quarterly noise and short-term volatility. This strategic patience eliminates the greatest drag on active management returns: overtrading. Greenblatt's secret isn't a complex, proprietary trading strategy. It is a mechanical, disciplined application of Benjamin Graham's core value principles. It allows the individual to practice active selection while maintaining the emotional discipline of a passive investor, proving that the best investment strategy is the one that minimizes human error and maximizes the chance for long-term compounding. The secret, therefore, is not just a financial formula, but a powerful prescription for emotional stability in a financially unstable world. That's right. We've established what the formula is. Now we must understand the crucial why. Why does this mechanical, almost childlike method consistently outperform the sophisticated world of algorithms and high finance? The answer, as Joel Greenblatt explains in this chapter, lies not in advanced mathematics, but in the enduring, predictable irrationality of human nature. Here is Chapter 4, Why the Formula Works, a deep look into behavioral and structural inefficiencies that fuel the magic formula's enduring success. Chapter 4, Why the Formula Works. In the halls of academia, the efficient market hypothesis, EMH, posits that asset prices fully reflect all available information. If this were completely true, Joel Greenblatt's simple formula, or any consistent market-beating strategy, would be impossible. The stock market should be a perfectly rational machine. Greenblatt does not dismiss this idea entirely. He simply points out that the market is mostly efficient, but in its moments of spectacular inefficiency, it creates opportunities large enough for disciplined investors to drive a truck through. These windows of opportunity are not random glitches in the machine. They are predictable breakdowns caused by human emotion, structural flaws, and the constant pressure of short-termism. Chapter 4 is the crucial bridge between the theory of value investing and the reality of the market. It explains that the formula works because it systematically captures the two most common and expensive mistakes made by investors. The two market failures the formula exploits. The magic formula is designed to be the mechanical opposite of emotional investing, ensuring the user profits from two primary market failures. Failure 1, the mispricing of quality, overpaying for certainty. The first way the market misfires is by massively overpaying for the comfort of certainty. A company with a high return on capital (ROC) is, by definition, a great business. When a company announces stellar earnings for 5 quarters in a row and seems poised for perpetual growth, the market, fueled by greed and recency bias, rushes in and bids the stock price up to absurd levels. The market is so eager to guarantee its participation in this sure thing that it drives the earnings yield EY down to near zero levels. The stock may still be a good business, but at that price, the expected future return is extremely low. Greenblatt's formula exploits this failure by recognizing that the price paid is the single greatest determinant of future return. The formula's action. The magic formula does not ignore these great companies. It simply refuses to buy them when they are priced for perfection. It systematically rejects the common, high-priced growth stocks and seeks out equally high-quality companies that are currently priced at a discount. It forces the investor to be a disciplined buyer of future uncertainty at a low cost, rather than a frantic buyer of present certainty at a high cost. This is a principle that counters the modern phenomenon of IPO hype and growth at any cost investing. The market, propelled by social media financial panic cycles, willingly pays valuations for startup technology companies that are divorced from any current or near-term return on capital. The formula simply waits, knowing that the gravity of valuation will eventually pull these prices back to earth. Failure 2. The mispricing of value, underappreciating temporary pain. The second, more lucrative failure of the market is its inability to endure temporary pain. A company with a high ROC facing a temporary setback, a legal battle, a supply chain hiccup, a temporary earnings miss, will be immediately punished by the market. The short-term institutional investor, governed by the fear of relative performance and quarterly reports, must sell. The herd mentality dictates that any hint of bad news requires immediate exit. The formula's action. The disciplined investor using the magic formula sees this momentary panic as a spectacular opportunity. A great business, temporarily hobbled, will see its stock price drop, causing its earnings yield EY to spike dramatically. The formula, which is programmed to find the cheapest stocks, ranks this temporarily distressed company highly. It forces the investor to buy against the fear of the crowd. This systematic buying of temporary pain is the reason the formula works over the long term. These companies, which are still fundamentally high quality, will inevitably fix their temporary problems. And when they do, the market's emotional mispricing will correct, delivering massive, market-beating returns to the patient owner. The essential ingredient, the pain barrier. If the formula is so simple and consistently successful, Greenblatt's backtesting showed phenomenal returns. Why doesn't every hedge fund manager on the planet use it? The answer is the single most important lesson of Chapter 4. The formula must endure periods of underperformance, and most investors lack the emotional fortitude to stick with it. The formula forces an investor to buy companies that are, by definition, unloved. This means that when you implement the strategy, many of your chosen stocks will continue to perform poorly for a significant amount of time. You will be actively buying the ugliest stocks, and they may continue to get uglier for 18 to 36 months. During these periods of underperformance, your neighbors will win. You will watch the stocks you didn't buy, the Tesla hype and crypto bubbles skyrocket, triggering intense FOMO. The formula will look broken. Your portfolio will lag the index, making your disciplined active strategy look like foolishness compared to passive investing in an ETF. The media will mock you. Financial news and financial influencers will loudly celebrate momentum investing, reinforcing your feeling that you are wrong. This pain barrier is the cost of admission. The magic formula only works because most investors, especially the impatient, quarterly-driven professionals and the zero-commission trading amateur driven by instant gratification, quit when it hurts. The very existence of the underperformance guarantees the future overperformance. If the strategy worked every single year, everyone would use it, and mispricings would immediately disappear. Modern investing reflection, countering digital biases. Greenblatt's analysis of market failure is perfectly suited for the digital age, where psychological biases are magnified by technology, the weapon against behavioral biases. The formula acts as a mechanical check against the most destructive cognitive biases that govern day trading psychology. Herding. The formula forces you to buy what the herd is selling. Recency bias. The formula forces you to ignore recent bad news and focus on long-term return on capital. Availability heuristic. Social media constantly bombards us with high-profile winners. The formula forces us to look in the hidden corners, away from the digital spotlight. The investor who succeeds with the magic formula is the one who understands that emotional discipline is more important than intellectual genius. They must choose to follow the logic of the numbers over the primal urges of greed and fear. The critique of index fund limitations. Greenblatt's work highlights a major structural limitation of ETF dominance. Passive index funds are designed to own the market's winners and losers in proportion to their market capitalization. This means passive funds are structurally forced to hold more of expensive stocks, low EY, and fewer of the cheap stocks, high EY. By contrast, the magic formula is a value tilt strategy. It forces the investor to overallocate to the temporarily depressed, undervalued portions of the market. The structural divergence, buying the cheap while the index buys the popular, is the engine of the outperformance. In short, Greenblatt's formula works because it understands that human behavior is the market's greatest and most persistent inefficiency. The formula doesn't try to predict the future. It simply identifies where human emotion has caused a spectacular error in pricing the present. The disciplined investor superpower is the calmness to buy that error and the patience to wait for the market to reluctantly admit it was wrong. Absolutely. Greenblatt spends an important chapter here providing the rationale for his formula, not just as a profitable strategy, but as a superior philosophical alternative to the dominant force in finance, passive investing. Here is Chapter 5, Why Not Just Buy Index Funds, expanded into a deep, critical analysis of the structural flaws in market cap weighting. Chapter 5, Why Not Just Buy Index Funds? If you are a disciplined investor committed to long-term thinking, the recommendation to simply buy a diversified index fund is arguably the best advice you will ever receive. It is low cost, requires minimal effort, and guarantees you will achieve the average return of the entire market, which is a fantastic result for most people. Joel Greenblatt, the successful hedge fund manager, does not dispute the wisdom of passive investing. In fact, he endorses it as a default choice for the vast majority of investors. But in this critical chapter, he raises a philosophical and structural challenge to the prevailing tide of ETF dominance. If you can systematically, simply, and mechanically improve upon the core flaw of the index, why wouldn't you? Chapter 5 is a rationalist critique of the market's default setting. It asks us to look beyond the convenience of the index and understand the single, inherent structural flaw that creates the massive opportunity for the magic formula. The Achilles heel of market cap weighting. The engine of the modern ETF dominance is market capitalization weighting. This is a method by which standard index funds, like the S&P 500 trackers, determine how much of each company they hold. They simply hold more shares of the companies with the highest total market value and fewer shares of the smaller companies. This weighting methodology has a fatal, structural flaw, which Greenblatt dissects with surgical precision. The index fund is forced to buy the most of what is most expensive and the least of what is cheapest. Think of the index fund not as a smart algorithm, but as a perpetual buying machine with a single, unalterable directive, always by proportional to the current price. When a stock like Apple or Microsoft grows so large that it dominates the S&P 500, the index fund is forced to allocate billions of dollars more to that stock, regardless of whether its current price-to-earnings ratio is justified by its future growth. The index fund is price blind. It has no mechanism for determining value. It accepts the current market price as the only truth. Greenblatt explains that the index fund is systematically violating the core secret of value investing. Chapter 2, it buys good businesses, but buys them regardless of how cheap the price is. In fact, it tends to buy them most aggressively when they are at their most expensive. This structural inefficiency acts as a drag on the index's overall returns, ensuring that the average return is just that, average. The passive versus active conundrum, the middle ground. The traditional passive versus active investing debate presents a false dichotomy. Either you accept the low-cost, average returns of an index, or you pay high fees to a human fund manager who will likely underperform due to emotional errors and short-term pressure. Greenblatt's formula introduces a powerful, rational middle ground, mechanical value indexing. It rejects the active flaw by making the process mechanical. Greenblatt removes the high fees, the career risk, the emotional discipline failures, and the day trading psychology that doom traditional active managers. The magic formula is run like an algorithmic trading strategy based on logic, not gut feeling. It corrects a passive flaw by replacing market cap weighting with value weighting. The formula actively seeks out the mispricings that the passive index is structurally obligated to ignore. The magic formula systematically forces the investor to buy more of the companies with the highest earnings yield EY, the cheapest ones, and fewer of the companies whose valuations are stretched. The formula is, therefore, a superior form of indexing because it retains the discipline and low cost of passive investing while correcting the flawed weighting logic inherent in the S&P 500. It doesn't bet against the market. It simply chooses to own the cheapest, highest quality slice of the market. ETF dominance and the inflation of megacaps. This critique of market cap weighting is particularly urgent in the 2020s, an era defined by overwhelming ETF dominance. The massive, relentless flow of capital into passive index funds has created a self-fulfilling prophecy, particularly among megacap technology stocks. The feedback loop. As hundreds of billions of dollars are poured into passive ETFs, that capital is mechanically distributed based on market cap. The largest companies receive the biggest influx, which pushes their stock prices even higher. This larger price increases their market cap further, which forces the index funds to buy even more. Inflated valuations. This creates a structural upward pressure on the most expensive, most popular stocks, the kind of environment that fosters Tesla hype and similar growth at any cost narratives. The index funds are not validating the valuation. They are simply acting as an enormous price-insensitive buyer. The opportunity. Greenblatt would point out that this passive feedback loop leaves massive opportunities in the mid and small cap space. As capital blindly chases the largest market cap stocks, it leaves behind fundamentally strong, highly profitable but smaller companies, the very good businesses at cheap prices that the magic formula is designed to scoop up. The bigger the flow into the S&P 500, the greater the returns for the disciplined value indexer. The value of patient nonconformity. Ultimately, Chapter 5 is a lesson in intellectual nonconformity and long-term thinking. Greenblatt emphasizes that the reason the formula works is that its results are not smooth. If the formula worked every quarter, the entire market would adopt it and mispricings would instantly disappear. The formula only delivers its excess returns because the investor has the patience to endure the periods, often 18 to 36 months, when the market ignores their selections and the portfolio lags the main index. This willingness to look foolish compared to market consensus is the cost of the premium return. The individual investor, free from the constraints of relative performance, has a unique ability to pay this cost. They can stick with their low-priced, unloved selections, confident that eventually the market will recognize the underlying value, forcing the passive index funds to belatedly allocate more capital to those stocks at the now higher price. Greenblatt's book is an invitation to be actively rational rather than passively average. It teaches that the market's greatest weakness, its susceptibility to emotional mispricing and structural flaws like market cap weighting, is the individual investor's greatest structural opportunity, provided they can maintain the necessary emotional discipline and calmness to ignore the prevailing noise. Yes, having critiqued the structural flaws of the market, Greenblatt dedicates this essential chapter to the necessary philosophical shift, the single greatest mental barrier that prevents most investors from achieving success. Here is Chapter 6. Stocks are parts of businesses, expanded into a detailed exploration of the required value investing mindset. Chapter 6. Stocks are part of businesses. If you were to ask a child or perhaps an alien visitor what a stock is, they might logically conclude as a flashing red or green number on a screen, a gambling chip, or a digital asset whose only value is derived from the price at which the next person is willing to buy it. This, tragically, is a pervasive modern delusion. In Chapter 6, Joel Greenblatt delivers the single most critical philosophical concept in all of value investing, one that anchors his entire formula and provides the strongest defense against financial hysteria. A stock is not a ticker symbol. It is a fractional ownership stake in a real, living, breathing business. This mindset shift is the fundamental difference between the anxiety-ridden speculator and the calm, compounding wealth creator. The goal of this chapter is to rewire your brain to stop thinking like a trader and start thinking like an owner. The Great Detachment. Why the stock market fails us. The reason most retail investors fail is the Great Detachment created by modern technology. Zero-commission trading and instant market access encourage us to treat stocks like abstract financial instruments. We see the price, the momentum, and the volume, but we lose sight of the physical reality beneath the ticker. The factories, the patents, the customer lists, the motivated employees, and the cash flow. Greenblatt insists that successful investing requires a deliberate, daily act of imaginative thinking. Imagine you are buying an entire company, not just 100 shares. The pizza parlor analogy, the true metrics of ownership. Greenblatt uses a simple, powerful analogy of buying a local business, like a pizza parlor, to illustrate the rational metrics that truly matter. When you buy a pizza parlor, what do you care about? Profitability and efficiency. The good business, you want to know how much cash the parlor generates compared to the total investment required. The return on capital. You would never buy a parlor that requires $500,000 in equipment, but only generates $10,000 in profit. You look at the quality of the operation. Purchase price. The cheap price, you compare the annual cash flow, the earnings, to the total price tag, the enterprise value. If one parlor costs $1 million and generates $150,000 annually, and another costs $2 million and generates $150,000, the first is clearly the better deal. You look at the value you receive for your cost. Crucially, as a business owner, you would never look at the newspaper every day to see what a random person might offer you for your parlor. You would check the cash register and the bank account to see how the business is performing. This focus on cash flow and cost is the simple, rational reality of business. The magic formula is nothing more than the systematic application of this pizza parlor logic to the highly emotional, chaotic stock market. It forces the investor to stop chasing price and start checking the cash register. The tyranny of Mr. Market. This chapter also brings back one of the most powerful allegorical figures in value investing, first introduced by Benjamin Graham, Mr. Market. Mr. Market is your theoretical partner in the pizza parlor business. Every single day, he shows up at your door, offering to buy your stake in the parlor or sell you a steak. Sometimes he shows up euphoric, offering a price twice what the parlor is worth. Other times, he shows up depressed, panicking over a slow Tuesday, offering to sell his steak for half the true value. The core lesson is that Mr. Market is a manic-depressive figure. His daily mood swings should never determine your valuation. They are simply an option offered to you. You are free to ignore him on his manic days, when the stock is overpriced, and to eagerly buy from him on his depressive days, when the stock is cheap. The speculator treats Mr. Market's daily price as the gospel, reacting emotionally to every fluctuation. The owner, armed with the knowledge of return on capital and earnings yield, knows the true value of the business and ignores Mr. Market until his price is ridiculously cheap. This perspective is the essential source of calmness and emotional discipline in the face of volatility. Modern investing reflection, countering digital detachment. The philosophical call to view stocks as businesses is the most essential defense against the specific psychological hazards of the 2020s digital market. The zero-commission trap. Stocks as gambling chips. The ease of zero-commission trading and the rise of day trading psychology have exacerbated the problem of detachment. When trades are free and instantaneous, a stock ceases to be a long-term asset and becomes a short-term chip in a digital casino. The modern investor is bombarded with advice centered on price patterns, short-term momentum, and technical analysis, all approaches that completely ignore the underlying business quality, ROC. The Greenblatt mindset provides a powerful ethical and logical correction. Every trade must be justifiable by the underlying business value. If you can't make a compelling business case for owning the stock for 5 years, you aren't investing. You are gambling. The Big Short and the value of the tangible. The lessons of the Big Short reinforce Greenblatt's message. The 2008 crisis occurred because financial products, CDOs, CDSs, became entirely detached from the tangible underlying assets, the houses and the debt. The failure of the entire system was the failure of people to ask, what is the actual physical reality of the asset we are trading? Greenblatt forces the investor to reconnect with the tangible. Even if the business is entirely digital, a software company, its value still rests on quantifiable physical facts. The number of paying subscribers, the cost of acquiring those subscribers, and the recurring revenue, all factors measured by return on capital and earnings yield. The Greenblatt investor is fighting the same detachment that led to the 2008 crisis, but applying the principle to the equity market, applying the owner mindset to hyperspeculation. How does the owner mindset address meme stocks and crypto hype cycles? By demanding a simple answer to the owner's question: how does this asset generate profit for me as the owner, regardless of the price I can sell it for tomorrow? A business, Greenblatt stock, generates profit through cash flow, which compounds over time. A classic meme stock, often trading at a massive valuation with poor return on capital and negative earnings yield, generates no profit for the owner. Its only hope of return is its rising price. The business owner mindset immediately rejects the speculative asset because its value is dependent entirely on the irrational actions of Mr. Market, the next buyer, not on the fundamental health of the business itself. The philosophical shift in Chapter 6 is the bedrock of long-term thinking. It provides a calmness needed for fire-based asset allocation because the investor is insulated from market panics. When the stock price falls, the owner thinks, the business is still generating cash flow, and I can buy more shares of this great parlor at cheaper price. This psychological transformation is the real superpower that Greenblatt unlocks. Yes, we now dedicate this entire section to the first, crucial pillar of Greenblatt's philosophy: quality. This is the core principle that anchors the formula in business reality and separates a mere speculation from a long-term investment. Here is Chapter 7. The importance of good businesses, a deep exploration of the power of return on capital, ROC. Chapter 7. The importance of good businesses. In the chaotic frenzy of the stock market, investors often obsess over the price. Did it go up today? Is it cheap enough to buy? Joel Greenblatt, a disciple of the timeless value tradition, flips the script entirely. He argues that before you ever consider the price, you must first answer a more fundamental question: is this business even worth owning? Chapter 7 focuses exclusively on the first component of the magic formula, return on capital, ROC, and why it is a superior, non-negotiable metric for defining a truly good business. This is a litmus test that separates the compounding machine from the capital incinerator. The efficiency imperative. ROC as the investor's compass. A high return on capital is the single most reliable signal that a company possesses a durable competitive advantage. It measures the efficiency with which a management team uses the money entrusted to it to generate profits. Imagine two competing factory owners, both given $1 million in investment capital. Factory A generates $300,000 in annual profit. Its ROC is 30%. Factory B generates $50,000 in annual profit. Its ROC is 5%. Regardless of the noise in the stock market or the CEO's charismatic speeches, the rational business owner knows they must invest in Factory A. The difference between a 30% ROC and a 5% ROC is the difference between a thriving, self-sustaining entity and one that is slowly destroying capital. Greenblatt's specific calculation of ROC, using EBIT over net tangible capital employed, is designed to be impervious to creative accounting and financing tricks. It cuts through the complexity to measure the actual operational output of the business, proving that operational efficiency, not clever accounting, is the key to quality. The compounding engine, why ROC drives long-term returns. The importance of a high ROC extends far beyond immediate profitability. It defines a company's capacity for exponential, compounding growth. This is a subtle, profound engine that separates the winners from the losers over a decade or more. A company with a high ROC has a massive advantage because it can reinvest its own retained earnings at that high rate of return. Consider a company with a 25% ROC. If it retains $10 million in earnings and reinvests it back into its operations, the company can expect that $10 million to generate $2.5 million in additional profit the very next year. This process snowballs. The high ROC not only delivers high returns on the initial investment, but also accelerates the growth of future profits. A low ROC company, by contrast, faces a painful dilemma. If they try to grow by reinvesting their low return earnings, They dilute shareholder value over time. If they want to expand and deliver acceptable returns, they must constantly seek new capital, issuing new debt or selling new shares, which burdens a business. Greenblatt shows that over the long term, high ROC companies are fundamentally self-funding, resilient, and structurally positioned to generate far superior returns than their low ROC competitors. They are the true wealth generators, and the magic formula insists that they must be the starting point for any investment selection. ROC as the moat indicator. In the world of business strategy, a moat is a structural defense that protects a company's high profits from competitive attack. If a company is earning high returns, high ROC, competitors will inevitably try to replicate that success, which drives down prices and reduces everyone's returns to the average. Sustained, high return on capital is thus the proof that a business has a strong, enduring moat. It signals that competitors cannot easily replicate the company's success due to barriers such as intangible assets, strong brand identity like Coca-Cola's recipe or brand power, network effects. The value of the product increases as more people use it, like social media platforms. Cost advantages, superior supply chains or proprietary technology that allows for production at a lower cost than rivals. The magic formula uses a pure, objective number of ROC to identify the result, the moat, eliminating the need for subjective analysis. High ROC is a financial evidence that the competitive landscape is favorable to the business owner. Modern investing reflection, defining quality in the digital economy. Greenblatt's insistence on ROC is more powerful than ever in the 2020s, providing a tool to separate real value from the ephemeral hype of the digital age. The intangible moat and high ROC. In the industrial age, a high ROC often came from owning scarce resources or efficient factories. In the digital age, the sources of high ROC are often intangible, but the principle remains the same. A software company or a data platform can scale its product globally with minimal additional capital investment. Once the initial code is written, the cost of adding 1 million new users, the marginal cost, is near zero. This leads to astronomically high ROC, as the net tangible capital employed, the denominator, is very low, while the EBIT, the numerator, is enormous. Greenblatt's wisdom. The sophisticated modern investor must recognize that high ROC still indicates quality, whether the capital is tied up in a machine press or in a data center. The formula is flexible enough to reward these highly efficient modern businesses, provided they are generating true profits and not just paper growth. This provides a clear, rational way to participate in the growth of the tech sector without succumbing to the hype surrounding companies that are growing revenue but burning cash, low or negative ROC. The critique of vanity metrics. The focus on ROC is the ultimate rejection of the vanity metrics favored by financial influencers and hyperspeculative behavior. Revenue growth. A company can grow its revenue by 50% year over year, but still be a terrible investment if it costs $1.50 to generate $1 of sales, i.e. low or negative ROC. Revenue growth without profit is simply a business model destroying capital faster. Stock price momentum. Option gambling and leverage addiction are focused entirely on momentum. ROC forces the investor to look at the source of the momentum. Is the stock rising because of social media trend or because the business itself is generating high returns on capital? Only the latter provides calmness and a margin of safety when the speculative tide turns. ROC and the FIRE investor. For the FIRE-based asset allocation investor, high ROC is the essence of long-term thinking. Investing is an act of delayed gratification, and you must ensure the underlying assets are structured to compound reliably. By systematically allocating capital to businesses with high ROC, the investor is ensuring that their savings are being put to work by the most efficient, best-managed companies in the world. This reliance on fundamental, measurable quality is a psychological anchor that allows the investor to be patient and ignore the social media financial panic cycles. When the market panics, the high ROC company still has its moat and still has its compounding engine running. This certainty of underlying quality is what keeps the Greenblatt investor calm when others are capitulating. Greenblatt's message in Chapter 7 is profound. Don't chase growth. Chase the efficient utilization of capital. By prioritizing the quantitative evidence of a moat, the high return on capital, You position yourself not as a mere speculator in market, but as a long-term partner in the world's most disciplined, best-run, and most profitable businesses. Yes, we now turn our focus to the second pillar of the magic formula, price. As Greenblatt teaches, a beautiful business is only a beautiful investment if you can purchase it at a spectacular discount. Here is Chapter 8, The Importance of Cheap Prices, a deep exploration of the power of earnings yield, EY, and the wisdom embedded in enterprise value, EV. Chapter 8, The Importance of Cheap Prices. If return on capital, ROC, measures the quality and efficiency of the business, earnings yield, EY, measures the fundamental stupidity of the market. This is the metric that finds the true bargains, the high-quality businesses that, for temporary, emotional, or structural reasons, have been discounted by the collective panic or short-sightedness of the trading world. Greenblatt's message in Chapter 8 is clear and absolute. No matter how good the business is, buying at too high a price guarantees poor future returns. The price you pay today is the single greatest determinant of your long-term success. The magic formula systematically forces you to exploit the market's irrational fear and greed by prioritizing the discount imperative, why price matters most. The fundamental reality of investing is that returns are generated by two factors: the business's internal performance and the change in its valuation multiple. While you have no control over internal performance, ROC, you have complete control over the valuation multiple you choose to pay, EY. A good business at a cheap price means you get the benefit of the company's internal compounding power, plus the added bonus of the stock's valuation multiple eventually returning to its rational average. This dual-engine return is why the magic formula consistently outperforms. The market's greatest failure is its tendency to price good businesses at too high a price and cheap businesses at too high a risk. The Greenblatt investor avoids the first mistake by demanding a high earnings yield. The superiority of earnings yield, EY. Greenblatt insists on using earnings yield, EBIT divided by enterprise value, as a superior measure of cheapness, moving beyond the simplistic price-to-earnings, PE, ratio favored by most amateur screens. PE is an incomplete picture. The traditional PE ratio simply compares the stock price to the earnings per share. It fails to account for debt, cash, and the complex financing decisions that can dramatically alter the true cost of acquiring the company. EY is the business owner's metric. By focusing on the percentage return, earnings/price, EY allows the investor to compare vastly different companies, a high-growth tech firm, a stable utility, a cyclical manufacturer, and judge them all by a single, universal standard. Which company offers the greatest operational profit stream relative to its total cost? This quantitative focus on a rate of return is the ultimate rational defense against the emotional narrative and FOMO culture that drives up valuations in modern markets. The wisdom embedded in enterprise value, EV. The true genius of Greenblatt's measure of cheapness lies in his use of enterprise value, EV, in the denominator. This is a critical piece of financial engineering that provides a necessary margin of safety for value investing. $/text enterprise value EV equals /text market capitalization plus /text total debt /text cash and cash equivalents $. As we learned in Chapter 3, enterprise value is the true purchase price of the entire business. It calculates the cost of buying all the stock, market cap, and then either taking on the company's liabilities, adding debt, or claiming its liquid assets, subtracting cash. The penalty for leverage addiction. By including total debt in the purchase price, the formula systematically penalizes companies that are highly leveraged. Imagine two companies, both with a market cap of $100 million. Company A has $0 debt. Its enterprise value is $100 million. Company B has $50 million in debt. Its enterprise value is $150 million. Company B is 50% more expensive to acquire than Company A, even though the price of the stock is the same. By forcing the investor to pay a higher EV for the debt-laden company, the earnings yield for Company B is dramatically lowered. This mechanism is Greenblatt's direct structural correction against the dangers of leverage addiction. Debt increases risk, particularly during economic downturns or social media financial panic cycles. The formula ensures that the disciplined investor pays a steep discount for accepting a higher risk, or better yet, is guided toward debt-free, more resilient companies. This is a crucial lesson that echoes the systemic dangers of leverage that were fully exposed in The Big Short, the reward for cash reserves. Conversely, by subtracting cash and cash equivalents, the formula rewards companies that have prudently built up large war chests of liquid assets. These companies are trading at an actual discount because part of their stock price is backed by cash the investor immediately owns. Cash provides optionality and calmness during crises. By using EV, Greenblatt created a measure of cheapness that is insulated from creative accounting and the external forces of financing. It ensures the investor is focused solely on the economic reality, the total cost versus the total profit stream. Modern investing reflection, countering hyperspeculation. The disciplined focus on earnings yield and enterprise value is the ultimate structural defense against the most common and destructive forms of modern speculative behavior, exposing the high cost of hype. The formula provides a clear, rational metric for rejecting the overvaluation prevalent in assets like Tesla hype or high-multiple tech stocks. These companies often trade at P/E ratios of 100x or more, translating to an earnings yield of 1% or less. Greenblatt would simply screen them out, not because he doubts their future potential, but because the price being paid today has already accounted for a decade of flawless, perfect execution. The formula's success relies on long-term thinking, demanding that the investor pay a price that offers a rational rate of return, a high EY, on current earnings. This forces the investor to bypass the crowded, overpriced growth stocks and look for value where the crowd has been too impatient or fearful to tread. EY is the antidote to option gambling. Option gambling and other forms of hyperspeculative behavior are almost entirely focused on maximizing leverage to profit from volatility, without regard for the underlying business quality or price. The Greenblatt investor, prioritizing a high EY, is fundamentally focused on safety and prudence. A high earnings yield creates a large margin of safety, a buffer between the stock price and the underlying value. If the stock falls by 20% due to an irrational social media financial panic cycle, the value investor has the confidence to hold or buy more because they know the original price was already cheap relative to the company's cash flow. The option gambler has no such safety net. Their bet is immediately liquidated. The value-weighted correction to ETF dominance. Chapter 8 reinforces a critique of passive investing introduced in Chapter 5. ETF dominance is price-weighted, meaning passive funds buy the most of what is expensive low EY. The magic formula, by prioritizing the highest earnings yields, systematically corrects this structural flaw. It creates a value-weighted index that is constantly fishing in the unloved, discounted waters of the market. This structural divergence, buying cheap while the index buys popular, is the engine of the formula's outperformance. The lesson from Greenblatt is that the pursuit of cheap price is not a search for mediocrity. It is a search for prudence. By insisting on the highest earnings yield relative to the true, full cost of the business, enterprise value, the disciplined investor anchors their portfolio in objective value, gaining the necessary calmness and emotional discipline to ignore the market's daily insanity and wait for the true value to be recognized. Yes, we have defined the quality and the price. Now we must put the pieces together. Chapter 9 is a mechanical culmination, the final instructions for translating philosophy of value into a diversified, executable portfolio. Here is Chapter 9. Putting it all together, a deep dive into the simple, powerful mechanics of executing the magic formula. Chapter 9. Putting it all together. The brilliance of the magic formula lies not just in its powerful metrics, return on capital, ROC, for quality and earnings yield, EY, for price, but in the final, non-emotional process of combining them. This chapter is a critical moment where Joel Greenblatt shows the investor how to transform a theoretical understanding of value into a systematic, repeatable engine for market-beating returns. This process is elegant because it is utterly agnostic to human opinion. It removes the two greatest pitfalls in active investing, emotional stock selection and insufficient diversification, by fusing quality and price, and then mandating a broad basket of stocks. The formula is built to win over the long term, regardless of the short-term noise. The fusion, combining quality and price. The actual mechanics of the magic formula are astonishingly simple, proving that high finance doesn't require complex arithmetic, but rather simple logic. The goal is to find the companies that rank highly on both efficiency and cheapness. Rank by ROC. For a large universe of companies, excluding financials and utilities, rank them numerically from highest ROC, assign rank number 1, to lowest. Rank by EY. Rank the same companies from highest EY, assign rank number 1, to lowest. Calculate the combined rank. For each company, simply add the two ranks together. E.g., a company with an ROC rank of 5 and an EY rank of 10 has a combined rank of 15. Select the best. The magic formula investor selects the companies with the lowest combined ranks. These are the companies that offer the best combination of good business and cheap price. This simple ranking mechanism systematically filters out the common market mistakes. It rejects the good businesses at expensive prices, high ROC, low EY rank, high combined score, and the cheap businesses that are poor quality, high EY rank, low ROC rank, high combined score. The formula only leaves a disciplined investor with the genuine bargains. The discipline of diversification, the 20 to 30 stock mandate. The second, equally vital component of Greenblatt's execution is the mandate for broad diversification. Greenblatt insists the investor must hold a portfolio of 20 to 30 stocks selected from the top of the formula's list, typically spread across 5 to 9 different industries. This may seem counterintuitive. If the formula is so effective, why not just pick the top 5 companies? The answer is the essential reality of value investing. The formula is a systematic strategy, not a prophetic tool. Risk mitigation. The formula correctly identifies a basket of stocks that are systematically undervalued. However, individual stocks may remain unloved for longer than anticipated, or they may face unforeseen, company-specific problems, like a lawsuit or regulatory change, that the metrics could not predict. By buying 20 to 30 stocks, the investor mitigates this idiosyncratic risk. Guaranteeing the strategy. The power of the formula is realized only when the average return of the entire basket corrects over time. Some stocks will fail, some will perform modestly, and a few will provide spectacular, multi-bagger returns. It is a performance of the basket that consistently beats the market, not the success of every individual pick. This diversification mandate is the investor's final piece of risk control, providing the calmness and certainty needed to ignore the inevitable short-term failure of a few individual selections. It shifts the investor's focus from worrying about single stocks to trusting the long-term mathematical validity of the systematic strategy. The discipline of rebalancing. Sell high, buy low. The final piece of the implementation puzzle is the annual rebalancing and holding period. Greenblatt's instructions are non-negotiable. Hold for 1 year. To minimize transaction costs and realize the full benefit of long-term capital gains tax treatment, where applicable, the magic formula mandates holding each stock for at least 1 year. Annual rebalancing. At the end of the holding period, the entire portfolio must be reevaluated. Selling winners. Companies that have performed well will have seen their prices rise, causing their earnings yield, EY, to drop. The formula forces the investor to sell these winners because they are no longer cheap. Buying new value. The proceeds are then used to buy a new batch of 20 to 30 stocks from the current list of the lowest combined ranks. This rebalancing process is the ultimate systematic mechanism for selling high and buying low. It forces the investor to overcome the two most powerful emotional flaws: emotional attachment to winners and fear of buying stocks that are currently being sold off. The mechanical nature of the annual rebalance is the final, powerful act of emotional discipline that ensures the strategy remains profitable. Modern investing reflection, countering hyperconcentration. The disciplined execution rules of Chapter 9, Diversification and Systematic Rebalancing, are the essential antidotes to the most toxic trends in 2020's retail finance. Diversification versus the casino mentality. The rise of meme stocks and crypto hype cycles has fostered a dangerous culture of hyper-speculative behavior and concentration. Traders often put a massive, undiversified percentage of their capital into one or two volatile assets, viewing the market as an all-or-nothing gamble. Greenblatt's 20 to 30 stock mandate directly confronts this dangerous casino mentality. It teaches the investor that superior long-term returns come from risk management and probabilistic thinking, not from maximal concentration. The formula gives a FIRE-based asset allocation investor framework for active selection that is equally as safe as a passive index because the risk is broadly distributed. The correction to ETF dominance. While ETF dominance provides diversification, Greenblatt approach provides active diversification. The passive index is diversified based on size, market cap. The Magic Formula portfolio is diversified based on value and quality. The formula's active selection of 20 to 30 stocks ensures the investor is not exposed to the systematic flaw of the passive index, overweighting expensive megacaps. It creates a highly customized, actively managed small index that targets the market's inefficiencies, providing a structurally superior approach in the passive versus active investing continuum. The discipline of letting go. The requirement to sell winners is the most powerful psychological test of the magic formula in the age of social media financial panic cycles. When an investor sees a stock they bought cheap go up 150%, the temptation is immense to hold on and wait for the next leg up. This emotional attachment prevents them from realizing the profit and reinvesting that capital into new, equally cheap opportunities. The annual rebalance forces the investor to ignore the ego of winning and instead follow the pure logic of value. The stock is no longer cheap, so it must be sold. By systematizing the process of buying the unloved and selling the loved, the magic formula ensures that the investor remains a rational opposite of the manic-depressive Mr. Market, cementing the necessary long-term thinking and emotional discipline required to succeed. Yes, having delivered the secret and the formula, Joel Greenblatt now offers the essential chapter of realism. This is the fine print, the warning label, and the psychological test that ensures only the disciplined investor truly benefits. Here is Chapter 10. Some caveats, a deep dive into the necessary psychological and practical constraints of the magic formula. Chapter 10. Some caveats. A map is useless if the traveler lacks the endurance to follow it. The magic formula is a mathematically sound, historically back-tested roadmap to market-beating returns, but as Joel Greenblatt cautions, it requires a non-mathematical ingredient that most investors lack: psychological fortitude. Chapter 10 is the crucial reality check. It explains that the very mechanism that makes the formula profitable, exploiting human emotion, also ensures that the majority of people who try the strategy will abandon it too soon. Greenblatt lays out the essential caveats, which are less about financial mechanics and more about emotional discipline and the enduring struggle against human nature. Caveat 1. The pain barrier and the guarantee of failure. This is the single most important warning Greenblatt delivers. The formula is guaranteed to endure significant periods of underperformance. The reality. Historical results show that the magic formula typically works over a 3 to 5 year cycle, but within that cycle, it will underperform the general market index, like the S&P 500, for periods lasting 18 to 36 months. The mechanism, this underperformance is not a bug. It is a necessary feature. The formula works because it forces you to buy what is currently unloved, low price / high EY. If the market's irrationality corrects quickly, the returns are immediate. But if the market takes 2 years to realize its mistake, you must endure 2 years of lagging returns. This pain barrier is the cost of admission. The psychological trap. Greenblatt understands that when a portfolio lags the ETF dominance of the passive index for 2 years, the investor's natural instinct is to conclude the formula is broken, the market has changed, or the strategy is obsolete. They quit, usually right before the massive correction that delivers the formula's excess returns. The formula works because most people lack the patience to let it work. For the investor influenced by FOMO culture and the instant gratification of hyperspeculative behavior, this caveat is the ultimate test. You must be prepared to see your peers making explosive gains in crypto bubbles and meme stocks while your disciplined, value-based portfolio sits flat. The only defense is long-term thinking and an absolute mechanical commitment to the 5-year plan. Caveat 2, no tinkering allowed, the consistency mandate. Greenblatt stresses that the formula must be followed precisely and mechanically over the long term. This caveat directly confronts the greatest psychological flaw of the amateur, the desire to tinker. The moment an investor starts trying to improve the formula by substituting metrics, timing the entry and exit points, or holding on to a stock past the one-year rebalance because they like the company. They introduce human emotion and bias, guaranteeing the erosion of returns. The danger of day trading psychology. The constant temptation afforded by zero-commission trading feeds the day trading psychology, encouraging the investor to deviate from a mechanical system. Greenblatt's message is firm. Your personal, emotional decisions are less reliable than a simple, back-tested formula. The consistency of the process is the key, not the brilliance of any single stock pick. The social media test. This temptation tinker is amplified by financial influencers and social media financial panic cycles, which constantly promote fleeting strategies and urge immediate action. The Greenblatt investor must view the formula as a passive execution, active selection algorithm that cannot be overridden by fear or greed. The success relies on the investor's ability to maintain emotional discipline and follow the mechanical rules exactly year after year. Caveat 3. Structural exclusions, financials, and utilities. Greenblatt specifically warns investors to exclude financial companies, banks, insurance firms, and public utilities from a magic formula stock universe. This is a practical constraint rooted in financial accounting reality. Financial companies. Banks and insurance companies operate under a completely different accounting model, where debt is their inventory. Their balance sheets are structurally different, making Greenblatt's definition of net tangible capital employed and return on capital ROC virtually meaningless for comparison. Their high leverage addiction is part of their business model, making the formula's metrics unreliable as indicators of quality. Utilities. Utilities are often government regulated and granted local monopolies, but their return on capital is legally capped. Their prices are set by regulatory bodies, not by competitive market forces. This unique structure renders the magic formula's comparative ranking system ineffective for assessing their relative value. This caveat reinforces the theme of intellectual honesty. The formula is a great tool, but the disciplined investor must know its limits and only apply it where the underlying accounting principles are sound. Caveat 4. The small cap and mid cap sweet spot. Greenblatt reiterates that the most pronounced mispricings, the largest opportunities for returns, are found in the small and mid cap space. Why not mega caps? As discussed in Chapter 1, the largest companies are heavily analyzed by Wall Street and are often systematically included in major index funds, ETF dominance. This flood of institutional capital removes most of the obvious mispricings, driving prices closer to their true value. The inefficient field. The formula works best in the least efficient, most fertile ground of the market, where institutional funds cannot easily deploy their massive capital, the privilege of smallness. While you can apply the formula to large companies, the expected excess return will be smaller, closer to the market average. This reinforces the importance of using your superpower as an individual investor. You are free to hunt in the inefficient corners of the market, where the professional investors are barred by size and career risk. The formula rewards the investor who is willing to look past the high-profile mega-cap Tesla hype and instead focuses on the boring, forgotten, high-quality mid-cap gem. The ultimate lesson. Consistency is key. The ultimate lesson of some caveats is that the magic formula is not a prediction tool. It is a mechanical discipline. Its success is derived entirely from the investor's calmness and their willingness to let the process unfold over a meaningful time horizon, impervious to surrounding noise. This chapter forces the investor to confront the two questions that separate the winners from the quitters. Can I handle the pain of underperformance? And can I be disciplined enough not to tinker? In the modern financial environment, where every second brings a new trade opportunity or a new speculative frenzy, Greenblatt's caveats are the bedrock of long-term thinking. They teach that the difficulty of investing is not the math. The math is simple, but the psychology, the excess returns, are simply the emotional compensation the market pays you for being disciplined and patient when everyone else is panicking or quitting. Yes, we now arrive at the ultimate moment of vindication, the cold, hard, quantitative evidence. This chapter provides the necessary proof that allows the disciplined investor to overcome the inevitable psychological challenges of the future. Here is Chapter 11, Results, a deep dive into the compelling historical data that validates the magic formula's enduring success. Chapter 11, Results. In finance, everything else is conversation. Only the results matter. After explaining the philosophy, the secret, and mechanics, the formula, and issuing the warnings, the caveats, Joel Greenblatt dedicates Chapter 11 to presenting the empirical evidence, the back-tested historical data that proves the magic formula works. This chapter provides the ultimate psychological anchor for the investor, a certainty based not on prediction, but on decades of proven statistical fact. The data Greenblatt presents is nothing short of staggering, demonstrating that a simple mechanical application of two metrics consistently delivered massive, market-beating returns over various economic cycles. This statistical victory is the final argument against the pervasive noise of FOMO culture and emotional chaos of the trading world. The quantitative proof, compounding superiority. Greenblatt's core data comes from testing the magic formula against the entire universe of applicable U.S. stocks over a long, punishing period, a period that included bear markets, bubbles, and periods of high inflation. The results consistently demonstrated that the formula, applied to a portfolio of 20 to 30 of the highest-ranking stocks, generated annualized returns far exceeding those of the general market index. The magnitude of outperformance across multiple test periods, the formula often generated average annualized returns in the high double digits, e.g., often exceeding 30%, compared to general market index, like the S&P 500, averaging in the low double digits, e.g., 10 to 12%. The difference between a 12% annual return and a 30% annual return, sustained over 2 decades, is not just incremental, it is exponential. This difference transforms the final wealth outcome from significant to life-altering. The historical data proves that the calmness and long-term thinking required by the formula are the most highly compensated virtues in the financial world. The reliability across cycles. Crucially, Greenblatt's testing showed that the formula's success was not tied to any specific market environment. It worked during periods of slow growth, during periods of high economic expansion, and, most importantly, it recovered strongly after major market downturns. The timelessness of value. The formula's success across different cycles proves that its principles are timeless. The market, regardless of whether it is fueled by the Tesla hype of one decade or the dot-com bubble of another, continues to make the same emotional mistakes, overpaying for growth and panicking during temporary dips. The formula systematically exploits these mispricings, whether the economy is up or down. The small cap edge vindicated. The data also clearly supported the privilege of smallness, Chapter 1. The formula's returns were dramatically higher when applied to the small and mid-cap universe, confirming that the largest and most persistent mispricings occur with a massive, short-term focused institutional money, burdened by ETF dominance, cannot easily operate. This statistical vindication is the final encouragement for the individual investor to use their structural freedom, the numerical justification for the pain barrier. The most important data point in this chapter is not the spectacular final return, but the numerical proof that the formula must underperform periodically for it to work. Greenblatt's backtesting revealed that despite the impressive long-term average, the magic formula underperformed the index in approximately 30 to 40% of all measured rolling one-year periods. Underperformed the index in significant stretches, sometimes lasting 2 to 3 years. This historical reality provides a numerical shield against the psychological pain warned of in Chapter 10. The investor can look at the data and realize, when the portfolio is lagging the index for 18 months, that is not a sign of failure. It is a sign that the strategy is working perfectly, accumulating cheap assets while the impatient majority bails out. The period of underperformance is a statistical engine of the future outperformance. Modern investing reflection, data as a shield against chaos. The data presented in results is the ultimate weapon the Greenblatt investor possesses to combat the high-speed chaos of the 2020s, demolishing the hyper-speculative fallacy. The long-term, compounding power demonstrated by the formula statistically demolishes the seductive but destructive narrative of hyper-speculative behavior and option gambling. Low probability versus high certainty. The average day trading psychology relies on hitting a handful of low probability, short-term wins. The formula, by contrast, relies on a high probability, systemic process that guarantees a superior return on average over a sustained period. The data proves that disciplined patience is statistically superior to high-risk gambling. Compounding for FIRE. The difference between a 12% and a 30% return means that a FIRE-based asset allocation investor could potentially achieve financial independence in half the time. The formula provides the most efficient use of patient capital, rewarding the investor who focuses on the quiet power of compounding over the noise of short-term volatility. The ultimate defense against FOMO culture. The historical performance data serves as the ultimate psychological defense against FOMO culture and social media financial panic cycles. When an investor is tempted to abandon the formula to chase the next crypto bubble or meme stock, the data provides a definitive answer. Why would you trade a statistically proven strategy that has a near-guaranteed long-term excess return for a high-risk gamble with a 50-50 chance of ruin? The long-term data proves that the disciplined path, even with its periods of pain, is the only statistically viable path to generating true, market-beating wealth. The lesson of Chapter 11 is one of pure, unemotional confidence. The formula works because it is rooted in value, and value always asserts itself over time. The investor's job is simply to believe the numbers over the headlines, maintain the requisite emotional discipline, and let the proven mathematics of value investing run its course. Yes, we have proven the concept with data. Now, we move from the quantitative proof to the practical blueprint. This chapter is the ultimate how-to guide for establishing a powerful, market-beating discipline. Here is Chapter 12, How to Become a Formula Investor, a deep, step-by-step breakdown of implementing the mechanical strategy in the modern age. Chapter 12, How to Become a Formula Investor. The brilliance of Joel Greenblatt's work is not that he found an exclusive secret, but that he provided an accessible machine for exploiting the market's inefficiencies. Chapter 12 is the owner's manual for that machine. It provides a simple 4-step mechanical process that eliminates guesswork, minimizes emotional error, and harnesses the individual investor's structural advantages. This section is about establishing a disciplined rhythm, a rhythm that cuts through the daily cacophony of social media financial panic cycles and day trading psychology. The transition from a theory-driven observer to a formula investor requires only the consistent execution of these steps, transforming complex finance into a simple, repetitive annual task. Step 1. The initial screen and universe definition. The first step in becoming a formula investor is meticulously defining the hunting ground. The universe of stocks the formula will analyze. The universe. The formula works best when applied to the entire available stock market universe, typically excluding stocks with extremely low market capitalizations, often below $50 million, due to low liquidity. The exclusions, as detailed in Chapter 10, the investor must immediately exclude financial companies, banks, insurers, and utilities. This is non-negotiable, as their unique balance sheet structures distort the return on capital (ROC) metric, compromising the entire comparative ranking. The modern tool. In Greenblatt's time, this initial screening required proprietary software or lengthy manual calculations. Today, the modern formula investor benefits from the democratization of data. Robust online screeners, often free or low cost, are available, capable of instantly calculating ROC and earnings yield, EY, using Greenblatt-specific definitions. The investor's job is to ensure the screener uses enterprise value and EBIT, not simpler, less accurate metrics like market cap and net income. This initial screening process is the investor's first act of intellectual honesty, ensuring that the formula is only applied to the companies that can be fairly compared, thus protecting the integrity of the data. Step 2. Ranking, selection, and mitigation of timing risk. Once the universe is defined, the investor must execute the ranking and selection process. Generate the ranks. Use the screener to rank all remaining companies by ROC and EY, and then calculate the combined rank. Select the portfolio. The investor chooses the top 20 to 30 stocks with the lowest combined rank. Greenblatt emphasizes buying a diversified basket of stocks from different industries to manage idiosyncratic risk. Mitigate timing risk. A massive psychological hurdle for any investor is timing the market. Should you invest all the capital today? Greenblatt advises against this all-at-once approach. Instead, he suggests a phased entry, buy 5 to 7 stocks per month over a period of 3 to 6 months. This phased entry is a mechanical mitigation of the investor's emotional desire to perfectly time the market's bottom. It transforms a lump sum problem into a scheduled, routine purchase, integrating elements of dollar cost averaging into an active strategy. It ensures the investor remains calm and avoids a temptation to wait for market crashes predicted by financial influencers. Step 3. The mechanical buy, the triumph of discipline. This is the moment where emotional discipline is paramount. The investor must buy the stock selected by the formula mechanically, regardless of their subjective opinion, the company's recent headlines, or the prevailing FOMO culture. The ugly stocks. The formula often ranks stocks highly because the market hates them. They are unloved, temporarily distressed, and possess bad headlines. The investor must be prepared to buy a stock that feels uncomfortable, knowing that the lack of comfort is precisely what creates the bargain price, high EY. Zero commission execution. The great benefit of zero commission trading is the ability to execute the 20 to 30 stock portfolio economically. The low cost allows the investor to spread their capital thinly across the required diversification, ensuring the long-term mathematical validity of the basket. The investor must use this low-cost environment as a tool for discipline, not as a license for frequent day trading psychology. The long-term pledge, this initial purchase, is a commitment to long-term thinking. The investor must mentally prepare to ignore this portfolio for the next 12 months, understanding that the formula works over years, not quarters. Step 4. The annual review, the engine of discipline. The success of the formula is maintained not by the initial buy, but by the systematic mechanical sell/buy process known as the annual review. This scheduled event is the ultimate test of the investor's fortitude. Timing. The review should be conducted once a year, preferably at the same time each year, to simplify record-keeping and tax considerations, maximizing the long-term capital gains holding period. The mechanical sell. Sell all stocks held for 12 months or longer. This rule must be absolute. The formula requires selling stocks that have reached their target holding period, regardless of whether the investor still likes the company or believes it is further to run. This forces the investor to overcome emotional attachment and systematically sell high, since the price correction has begun to close the valuation gap. The exception. Greenblatt suggests some flexibility on the timing of selling winners just before the 1-year mark to ensure the maximum tax efficiency, but the intent, to sell when the valuation multiple has compressed, remains. The mechanical buy. The cash from the sales is immediately reinvested into a new batch of 20 to 30 stocks selected from the current, updated formula list. This ensures that the portfolio capital is constantly being recycled into the most efficient, currently discounted opportunities. This annual rebalance is the formula's true engine. It eliminates the fatal psychological error of holding on to winning stocks too long, until they are expensive, and ensures that capital is never allowed to stagnate in overvalued assets. It is the perfect mechanical expression of sell high, buy low. Modern investing reflection. The formula and the FIRE investor. For the FIRE-based asset allocation investor, the magic formula's process is not just a path to market-beating returns. It is a framework for disciplined wealth creation that directly addresses the challenges of the 2020s. Automation and routine. The highly mechanical nature of the formula, from screening to the annual review, makes it perfectly suited for busy investors. It requires bursts of high-intensity work, the initial setup and the annual review, interspersed with long periods of calmness and inactivity. This is the opposite of day trading psychology, which demands constant attention and intervention, the shield against digital noise. The scheduled, objective annual review is the ultimate shield against social media financial panic cycles. The investor has an external logical event, the annual review, that dictates action, not the fear, greed, or market volatility of the moment. The investor ignores the daily noise and trusts the historical validity of the process. Compounding with purpose. By forcing the investor to constantly recycle capital into high ROC and high EY stocks, the formula ensures that the FIRE allocation is relentlessly focused on efficiency and value. This systematic, value-tilted approach is the most potent way to accelerate the compounding needed for financial independence, providing a significant expected edge over the simple but valuation-blind allocation of ETF dominance. Greenblatt's Guide to Becoming a Formula Investor is a masterclass in behavioral finance. It proves that the most powerful investment tool is not technology, but the investor's willingness to subject their emotions to a simple, objective machine. Yes, we now delve into more of the secret, where Joel Greenblatt peels back the final layers of his philosophy, revealing that the true engine of his success is not just arithmetic, but the synergistic power of mathematics and temperament. Here is Chapter 13. More of the secret, a deep exploration of the behavioral foundations that guarantee the formula's sustained outperformance. Chapter 13, More of the secret. If the first 12 chapters explain how to apply the magic formula, Chapter 13 shifts entirely to the philosophical and behavioral architecture that sustains its power. Greenblatt teaches that simply knowing the two metrics, return on capital, ROC, and earnings yield, EY, is insufficient. The true secret, the hidden power source that delivers the staggering results documented in Chapter 11, lies in the dual, compounding advantage the formula provides. The investor using the magic formula doesn't just get one edge. They get two, and these two edges, when combined with long-term thinking, create an almost unstoppable wealth-building machine. The dual engine of outperformance. The formula succeeds because it systematically captures and compounds two distinct types of inefficiency: the statistical edge and behavioral edge. Edge 1, the statistical edge value tilt. This is the quantifiable edge of the formula. The mechanical process of always buying good businesses at cheap prices. The mathematical guarantee. We know from Chapter 7 and 8 that buying high ROC companies ensures we are investing in powerful compounding engines, and buying high EY ensures we pay a low price for those earnings. This combination systematically selects for a value tilt, a portfolio that is structurally cheaper and more efficient than the market average. The compounding kickstart. By buying cheap, the investor ensures the stock has maximum upside potential as its valuation multiple normalizes. This initial discount provides an immediate kickstart to the compounding process, ensuring that the returns in the early years are significantly boosted, which then compounds exponentially over time. This is a simple mathematical force that the majority of investors, blinded by FOMO culture and the chase for expensive growth stocks, fail to capture. Edge 2, the behavioral edge, the non-intervention principle. This is the hidden non-mathematical advantage, and arguably the more important one. The magic formula is structured to systematically prevent the investor from making the most common, costly behavioral mistakes. Eliminating emotional selection. The mechanical ranking process, Chapter 3, forces the investor to buy stocks regardless of their gut feeling or the negative headlines circulating on social media financial panic cycles. Enforcing systematic profit-taking. The annual rebalance, Chapter 9, forces the investor to sell their winners, which are now expensive, and buy new cheap stocks. This eliminates the powerful and destructive emotion of emotional attachment to winning stocks, which causes most amateurs to hold on until the bubble bursts. The behavioral edge is the formula's ultimate shield. By eliminating the investor's ability to interfere, to sell during the panic, Chapter 10, or hold during euphoria, the formula allows the statistical edge to compound unimpeded over decades. The success of the formula is a triumph of discipline and mechanics over the innate flaws of human psychology. The deeper role of Mr. Market. Greenblatt returns to the allegory of Mr. Market, Chapter 6, with a deeper understanding of the market's psychological vulnerability. The true power of the formula is that it weaponizes Mr. Market's manic depressive behavior. The short-term price volatility, the daily chaotic fluctuations that fuel day trading psychology and option gambling, is not a risk to the formula investor. It is the source of the opportunity. Market chaos is inventory. The formula investor views the market's temporary sell-offs as a liquidation sale. Mr. Market, in his depressed state, driven by fear of global inflation waves or temporary earnings dips, offers shares of a great business at a ridiculously cheap price, high EY. The formula systematically forces the investor to take advantage of this temporary panic. Market euphoria's exit. Conversely, Mr. Market, in his manic state, driven by irrational optimism or Tesla hype, bids up the price of the formula selections to levels that are no longer justified by ROC or EY. The annual rebalance forces the formula investor to accept Mr. Market's inflated offer and sell the shares, ensuring the profit is realized and immediately recycled into a new, discounted opportunity. Greenblatt reveals that the chaos of the market is not something to be feared, but permanent, structural feature designed to reward the calm, patient, and mechanical investor. The formula is a perfect tool for systematically exploiting the market's predictable emotional swings. Modern investing reflection, the antidote to digital chaos. In the 2020s, The Secret has evolved into the ultimate guide for maintaining sanity against the pressures of digital finance. Compounding versus crypto re-risking. The crypto hype cycles and hyper-speculative behavior are the modern antithesis of the compounding principle. When a speculator makes a 100% gain on an asset, they must sell the entire position and re-risk the full 200% of their capital into a new, equally volatile asset to continue the growth. This is linear high stress and subject to immediate catastrophic loss. The magic formula, through its long-term thinking and reliance on ROC, ensures that the profits are reinvested within the high-quality business, generating compounded returns that are less reliant on the volatility of the external price. The formula is a steady, predictable marathon runner. Speculation is a chaotic sprint where every win requires immediate re-risking. The data, Chapter 11, proves the marathon runner wins the race over decades. The passive shield for active returns. The formula is the ultimate expression of active selection executed with passive temperament. Greenblatt's deepest secret is that he designed a strategy that provides the statistical superiority of active value investing while insulating the investor from the emotional turmoil that causes 99% of active managers to fail. By implementing a formula with zero commission trading, using the low cost to facilitate discipline, the investor gets the diversification benefits and the mental stability of passive investing by trusting a mechanical process, but the superior expected returns of actively exploiting value. The ultimate lesson of More the Secret is that the market is a psychological arena and the investor's greatest challenge is himself. The magic formula is Greenblatt's elegant solution, a mechanical, systematic application of logic designed to render human emotion irrelevant, ensuring that discipline is the only necessary ingredient for market-beating returns. Yes, the journey through the magic formula has been comprehensive, and now, Joel Greenblatt dedicates this essential chapter to anticipating and neutralizing the final. Psychological barriers, the inevitable skepticism, and the need to defend the simple truth against the allure of complexity. Here is Chapter 14, Answering Your Questions, a final, deep defense of the formula's logic and enduring efficacy. Chapter 14, Answering Your Questions. Skepticism is healthy in finance, but doubt is destructive. In this chapter, Joel Greenblatt addresses the dozens of common questions that arise once an investor grasps the magic formula. These questions are less about the math and more about the psychology, the difficulty of trusting a simple system when the rest of the financial world is so loud, complex, and frantic. Greenblatt offers his final, definitive defense of the disciplined value approach. This section serves as the ultimate firewall against the pervasive doubt amplified by modern social media financial panic cycles. Question 1. Does the formula still work today? This is the most critical question asked by every investor. If the formula is public knowledge, won't the market exploit it, and will its outperformance eventually disappear? Greenblatt's answer: human nature is perpetual. Greenblatt's definitive answer is based on behavioral finance. The formula works because it requires investors to buy what is currently ugly and unloved, and to endure painful periods of underperformance. Chapter 10. Human emotion, particularly the combined power of fear and greed, is a permanent, structural flaw in the market. It ensures that most investors will continue to sell low and buy high, abandoning the formula precisely when it is poised for its greatest returns. The amplification of inefficiency. In the 2020s, the formula is arguably more effective. The massive scale of ETF dominance means that capital is poured blindly into the market based on size, market cap, exacerbating the mispricings in the small and mid-cap sectors where the formula operates. Furthermore, the short-term focus amplified by zero-commission trading and day trading psychology ensures that the pain barrier remains psychologically unbearable for the majority. The simplicity of the formula is perpetually effective because the difficulty lies in the execution, not the calculation. Question 2. Why not use a formula for special situations? Greenblatt is also famous for his expertise in special situations, complex investments like mergers, spin-offs, and liquidations. The question arises, Why focus a little book on the simpler magic formula? Simplicity versus complexity. Greenblatt clarifies that while special situations can offer spectacular returns, they require intense analysis, deep legal and accounting knowledge, high capital concentration, and significant market sophistication. They are not suitable for the average individual investor. The magic of accessibility. The magic formula is deliberately simple, repeatable, and requires minimal intervention or complex data analysis. Its purpose is to deliver superior returns with low effort and high certainty, making it the best tool for the individual investor seeking market-beating performance without the stress or complexity often associated with high-risk ventures like option gambling or complex arbitrage strategies. The formula focuses on capturing the simple, persistent value gap, not the fleeting, complex situational gaps. Question 3. Should I buy all 30 stocks at once? As briefly addressed in Chapter 12, Greenblatt reinforces a mechanical rule against large, lump sum purchases to mitigate timing risk. The staggered approach. He reiterates the importance of buying the 20 to 30 stocks over a period of 3 to 6 months, e.g., 5 to 7 stocks per month. This staggered purchasing method integrates an element of dollar cost averaging into the active strategy, mitigating emotional failure. The staggered approach prevents the investor from succumbing to the emotional error of trying to time the bottom. It ensures that capital is deployed consistently and mechanically, further isolating the investor from the destructive influence of short-term volatility and the panic-inducing predictions of financial influencers. Question 4. How does this relate to the quality of the financials? Greenblatt addresses concerns about companies potentially using aggressive accounting to artificially inflate the two key metrics, ROC and EY. The margin of safety. Greenblatt argues that while some companies use aggressive accounting, the sheer diversification mandate, 20 to 30 stocks, and the margin of safety inherent in buying cheap high EY protect the investor. Even if a few companies are using questionable accounting, the overall performance of the basket is guaranteed by the mathematical weight of the correctly priced companies. The exclusionary principle. The systematic exclusion of high-risk financial companies, which are most prone to using opaque accounting to disguise leverage addiction, provides an essential structural defense. The formula focuses on industrial companies, where accounting is generally more straightforward, providing the necessary calmness and certainty for long-term thinking. Question 5. What about tax efficiency? Greenblatt uses this chapter to deliver his final, definitive defense of the one-year holding period and the annual rebalance, Chapter 9. Long-term capital gains. The one-year holding period is mandated not for the formula's performance, but for the investor's tax efficiency. Holding a stock for more than 1 year qualifies for preferential long-term capital gains tax rate, significantly increasing the final, realized compounding return. The cost of impatience. This is a direct structural argument against the high turnover, high tax inefficiency of day trading psychology. The data proves that while the formula may underperform in the short term, the final after-tax compounding return is vastly superior to the high-tax, high-cost returns generated by high-frequency trading. The formula is designed to maximize the efficient transfer of wealth to the investor's pocket over decades. Modern investing reflection. Final defense against doubt. Chapter 14 is the formula investor's final psychological armament against the 2020s market. The questions Greenblatt answers all boil down to desire for certainty in an uncertain world. The weapon against pervasive doubt. The modern investor is bombarded by so much information that the natural human reaction is doubt. The questions Greenblatt addresses. Is it obsolete? Is it too simple? Will I get tricked? Are precisely the questions that social media financial panic cycles leverage to induce fear and selling. Greenblatt's response is a powerful defense of simplicity and consistency. The formula's answers are derived from decades of data and basic business logic, providing the investor with the necessary internal fortitude to ignore the noise. The statistical evidence, Chapter 11, is the ultimate source of calmness. Simplicity as the ultimate complexity. Ultimately, Greenblatt teaches that the true path to complexity is not through obscure mathematics, but through simple, disciplined actions. The magic formula is complex only in its ability to mechanically overcome human error. This chapter reinforces a core lesson. The only thing standing between the individual investor and market-beating returns is the individual investor's own lack of discipline. The formula works. The investor must only commit to the long-term thinking required to let it work. Yes, we now arrive at the final chapter of Joel Greenblatt's remarkable book, a section that transitions from instruction to inspiration, providing the ultimate ethical and emotional framework for the value investor. Here is Chapter 15, One Last Thing, a final, powerful call for patience and discipline. Chapter 15, One Last Thing. We have reached the end of the written journey, but the investing journey is just beginning. Chapter 15 is Joel Greenblatt's final, essential message, delivered not as a financial expert, but as a mentor and guide. Having successfully armed the investor with the mechanical process, the formula, Greenblatt now provides a final ingredient that separates the long-term winner from the short-term quitter. The profound realization that simplicity, executed with total conviction, is the most powerful force in finance. This chapter is the ultimate emotional anchor, ensuring the disciplined investor understands that their goal is not merely to beat the market, but to achieve the peace of mind that comes from owning valuable, compounding assets. The ethical foundation of value investing. In the final chapter of the little book that beats the market, Joel Greenblatt brings us back to the philosophical and ethical core of value investing. The magic formula is not merely a strategy, not merely an algorithm. It is a moral discipline. It represents an approach to wealth building rooted in integrity, clarity, and respect for the real engine of value creation. Productive businesses, not speculative frenzy. Greenblatt's ethical framework is built upon two foundational pillars. 1. Honest ownership. The magic formula forces you into the mindset of a true owner. By selecting companies with consistently high return on capital, you are not betting on hype or illusions. You are investing in the real, tangible output of human ingenuity. You are aligning your financial destiny with businesses that solve problems, create products, and generate legitimate profits. You are not participating in the zero-sum game of speculation. You are participating in the positive-sum process of capital growth. This is a complete opposite of the dark financial alchemy that fueled the synthetic CDOs of the Big Short. Instruments built not on value, but on deception and complexity. The formula demands transparency and truth, a real business with real cash flow. 2. Rational pricing. The second ethical pillar is rationality. The formula insists you buy only when the price offers a significant margin of safety, measured through a high earnings yield. This is not greed. This is respect for your own capital. It is refusal to be seduced by bubbles or by the reckless optimism of the crowd. Overpaying is not just a financial mistake. It is a moral failure to protect your future self. Together, these two principles, honest ownership and rational pricing, form a complete ethical system. You are not trying to get rich off someone else's bad decision. You are trying to get rich with the continued success of quality businesses purchased at reasonable prices. This is what gives a formula investor extraordinary calm during volatility. The triumph of simplicity, rejecting complexity once and for all. Throughout the book, Greenblatt wages a quiet war against complexity. His final message is a resounding declaration. The world is complex, but your path to wealth does not need to be. Modern finance celebrates opacity, derivatives, quant models, algorithmic trading, AI-driven order flow. These tools pursue fleeting micro-edges, erased daily by competition. Greenblatt rejects this entire arms race. He shows that the enduring, undefeatable flaw in the financial system is not structural. It is human impatience. Don't try to look smart, try to be smart. This line is more than advice. It is a philosophical rebuke to the financial influencer culture, the jargon-heavy crash courses, and the dopamine-fueled speculation cycles dominating today's markets. Simplicity is not naive. Simplicity is sustainable. Simplicity is repeatable for decades, while complexity collapses during every major stress event. The magic formula is your badge of honor, proof that you understand what truly matters in wealth creation. The final plea: emotional discipline above all else. Greenblatt ends his book with a powerful truth. The magic formula works, but only if you do. The math is unquestionable. The historical data is overwhelming. Yet most investors fail, not because the strategy is flawed, but because they abandon it during periods of underperformance. There will be years, sometimes 3, sometimes even longer when the portfolio lags the index. During these periods, others will seem to be getting rich quickly. Social media will mock your patience. Meme stocks will surge. Influencers will scream about opportunities you're missing. This is the final test. Greenblatt knows that ego is the enemy of compounding. He urges investors to make a solemn commitment. Trust the annual rebalance. Trust the 5-year holding period. Trust the discipline more than your emotions. Trust the data more than your instincts. This is the mindset that transforms investing from a stressful, emotional hobby into a calm, mechanical discipline. This is the psychological foundation for fire-based investing. When you surrender to formula structure, you surrender the illusion of control and gain the reality of compounding. The owner's reward, peace of mind. Greenblatt returns, in his closing pages, to the most powerful philosophical shift of all. Think like a business owner, not a stock picker. This mental transformation gives you something more valuable than market-beating returns. It gives you peace, calmness during crises. When markets panic, due to inflation waves, geopolitical fear, or sudden liquidity shocks, the formula investor stays grounded. You bought high-quality companies, high ROC. You bought them at a discount, high EY. You have a margin of safety. Others may be forced to sell. You are not. Focus on what matters. By reducing investing to a mechanical task twice a year, Greenblatt frees your mind from the exhausting, low-return occupation of day trading. You no longer chase news cycles or dopamine spikes. You focus on life, family, personal growth. The things that compound in meaning while your investments silently compound in value. This is the true ethical reward. Your wealth grows without compromising your sanity. Modern context expansion. The value investor's defense against the digital casino. To apply Greenblatt's philosophy to the 2020s is to enter a world vastly noisier, faster, and more emotionally charged than anything he originally imagined. Yet every core mistake he warned about, overconfidence, impatience, fear, and greed, has exploded in magnitude. The illusion of intelligence, algorithms versus simple truths. Modern hedge funds operate on proprietary models so complex that even their designers cannot fully interpret them. Robo-advisors push billions into passive indexes, reinforcing systemic distortions. Social media financial gurus dispense dangerous, short-term advice disguised as wisdom. Greenblatt's reaction will be clear. This complexity is not a threat. It is your opportunity. The magic formula thrives precisely because mass capital is herded into complex, opaque systems that abandon valuation discipline. Meme stocks, crypto, and the rejection of value. Greenblatt would identify these speculative crazes as the clearest modern proof that investors have forgotten what ownership means. ROC, EY, cash flow, these words disappear during euphoria. When assets have no earnings, no business, no productive output, they cannot be valued. They can only be gambled on. And where there is gambling, there is eventually collapse. Fire, DCA, and the modern discipline renaissance. The formula integrates perfectly with FIRE principles and dollar cost averaging, offering a mechanical, value-tilted path to rapid compounding. Instead of blindly allocating into overvalued indexes, the investor systematically buys cheap, high-quality companies on autopilot. This is the disciplined middle ground between passive safety and speculative chaos. The final triumph of temperament. In a world flooded with information, automation, leverage, and hype, temperament becomes the rarest financial asset. Greenblatt's philosophy endures because it gives structure to human weakness. It replaces emotional chaos with mechanical calm. The magic formula does not require brilliance. It requires patience. It does not require forecasting. It requires faith in long-term value. It does not require perfect timing. It requires perfect discipline. And in the age of the digital casino, that discipline is worth more than gold. Here is part 4. Closing reflection. 10 timeless principles for the disciplined investor, designed to solidify the lessons of the magic formula. Closing reflection. 10 timeless principles for the disciplined investor. The journey through the little book that beats the market has revealed that the greatest secret in finance is not found in esoteric mathematics, but in the mechanical application of common sense. The formula is simple. The data is conclusive, and the psychological cost is high. The final step is to internalize the philosophy, transforming the two metrics, return on capital and earnings yield, into a permanent, unshakable mental model. The true success of the formula lies in its ability to enforce long-term thinking, patience, and emotional discipline. These are the 10 timeless principles extracted from Greenblatt's work. Principles that serve as a fundamental defense against the chaos of the modern financial world. The 10 commandments of value discipline. 1. Always think like an owner, never a speculator. A stock is not a lottery ticket. It is a fractional ownership stake in a real business with real cash flow. This mindset is the antidote to FOMO trading and option gambling. Before buying any asset, ask, if I had to own 100% of this business for 10 years, would I be satisfied with its cash flow and efficiency? If the honest answer is no, you are speculating, not investing. This mental anchor is the greatest source of calm during temporary price declines. 2. The price you pay determines the return you get. A great business purchased at a terrible price is still a terrible investment. Earnings yield, EY, must become your mandatory filter. High-growth darlings priced for perfection offer no margin of safety. Demand a discount. A high EY shields you from downside volatility and maximizes future compounding. 3. Complexity is the enemy of profitability. Greenblatt reminds us that the simplest businesses, those with high return on capital, create the highest long-term returns. Avoid businesses that require encyclopedic explanations, leverage balance sheets, or exotic financial magic. Simplicity compounds. Complexity decays. 4. Market irrationality is your everlasting edge. The market is efficient most days, but wildly irrational at crucial moments. Greed and fear, now amplified by social media, create spectacular mispricings. Treat panic as opportunity. Treat euphoria as caution. Your edge is not superior data, but superior emotional control. 5. You must be willing to endure pain. The magic formula will underperform, sometimes for years. This pain is the price of superior returns. Make a psychological contract with yourself. 5 years minimum before judging results. When your portfolio lags the index, remind yourself, this is the process working. Cheap assets require time to blossom. 6. Consistency beats timing. The danger of zero-commission trading is the urge to constantly tune your portfolio. Resist it. Follow the mechanical annual rebalance. Stagger your buying. Consistency transforms chaos into compounding. Timing transforms discipline into damage. 7. Diversification protects you from yourself. The formula thrives on groups of 20 to 30 stocks. Not every position will succeed, but the portfolio will. Avoid the ego-driven impulse to bet everything on one stock or one crypto coin. In a diversified formula portfolio, failure is a statistic, not a catastrophe. 8. Become your own algorithm. In a world dominated by high-speed quant funds, your advantage is not speed. It is patience. ROC and EY exploit inefficiencies inaccessible to algorithms that must act instantly. You are slow by design, and that slowness protects your returns. 9. Maximize after-tax compounding. Wealth is not built by trading. It is built by compounding. Avoid short-term trades that convert your gains into high-tax liabilities. 1-year holding periods are not just mathematically optimal. They are psychologically transformative. 10. True leverage is emotional, not financial. The greatest investor is not the one who borrows money, but the one who remains calm when others are drowning in fear. Emotional leverage allows you to buy when the leveraged masses are forced to sell. Calmness is your compounding engine. Deep, powerful closing thoughts. Greenblatt's final lesson is one of personal responsibility. He hands you a strategy that is simple, proven, and data-backed, but its power depends entirely on your discipline. The market will test you with panic, boredom, and temptation. Yet wealth comes to those who stay committed when others run. Choose to think like an owner. Choose long-term compounding over short-term excitement. Follow the formula, not because it is easy, but because it is true. If you are ready for me to begin planning the script for the next book, Reminiscences of a Stock Operator, based on your mention of Jesse Livermore, please confirm the next title. Otherwise, Please confirm that this project is complete.